Welcome to Witham Sounding Board, a podcast sharing powerful business tips, insights, and trends for those seeking to become a rock star in their industry.
This is Cuddy Thomas with Witham CFO Podcast. I am a senior manager in our outsourced accounting and fractional CFO services. We'll provide back office accounting support for levels ranging from staff accountant and all the way to CFO and anywhere in between. Our model is simple. We assume the role of your accounting department and we see ourselves as part of your team. If you'd like to know more about Witham, outsourced accounting and fractional CFO, please visit www.witham.com/oasis, and that's spelled OASYS. Joining me today is Jim Kelleher, who has had an impressive 25-year career as a CFO across multiple startups. He's now an angel investor and does CFO consulting for over 7 startups. My discussion with Jim will explore the evolving role of CFO. We'll talk about insights on scaling companies and lessons learned from investing and advising startups. So Jim, should I say boss? Welcome. How are you?
Excellent, my man. Excellent, Cuddy. Lovely to see you.
Same here. You've had an incredible journey as a CFO across multiple tech startups. I know that because I used to work for one of them. Can you share your career path and what drew you into the world of startups?
Sure, happy to. First, I appreciate you guys having me on the podcast. So thanks for the invitation and thanks for Witham for doing it. And thank you for the use of the word incredible in my career. But it's been a pretty good run. And I always tell people, I'm a basketball fan here in Boston, and Red Auerbach always had a saying, I'd rather be lucky than good. So to a certain extent, I've been lucky, but I think to a certain extent, I've made my luck in some ways. But if you go back in my career, I've been in the tech world for 40 plus years now. I started as a lot of people start in the finance world. I started as a chartered accountant or a CPA and spent 4 or 5 years at that with one of the big 8 at the time. They're now the big 4. And from there, I went into my first tech startup, which was one of my clients, and it was in the software world. And I've kind of ridden that tech world since. What attracted me to tech way back then, I think, was the youth involved in it, the energy in the tech space, the fact that it was changing so much. And that's what really got me into the first one. I happened to land in software, and I have pretty much stayed in the software space because I like it. And I've developed some expertise around certain things and helping grow organizations and scale organizations. But I took that first role at a company called Colonut Software way back in the late 1980s. It was actually an international role where I went overseas for 4 years as international finance director for Colonut Software. But since then, I've been a 4-time CFO now, 4 different startups. I was at a company called Paramount Technology for 10 or 11 years as manager of financial planning and then senior VP of finance. And I've had really good success in both PTC and the 4 different startups I've had. And one we'll talk about further in the podcast. One, we got to the public markets here in Boston, and then my most recent one, we scaled it for 5 years and then sold it at a very nice multiple to a private equity firm. So had some good economic outcomes, not only for myself, but for the investors, the management team, and the employee bases. So it's been a nice run, as you would say, Cuddy.
Very impressive. So looking back, what was your pivotal moment in one of those startups?
There were 2 that I would say sort of set me up, Cuddy. One is the first one that I just mentioned. The first place I went to was a company called Colonut Software. And what that entailed was I went into pretty immediately an operating role. So I was 26 years old. I'd stepped out of the United States for the first time, and I was international controller or finance director based in London. And I was immediately pushed into an environment where I was helping sales teams and sales managers do deals, structure deals, and get deals done in a way at that time that you could recognize revenue back at the United States, the parent company. So it really pushed me into an operational environment. And I've used that strength since, that ability to be more than a finance person and more than a CFO, but someone who can help an operator. And that was the basis of it, though. The second was kind of the next tech company I went to was a place called Pyramid Technology. That company back in the 90s was the hottest place to be in Boston, and it was one of the hottest companies in the United States. We went from 300 employees to 5,000 when I was there. I joined it at $45 million. We went to $900 million organic growth. We went from a valuation of $300 million in the public markets to one of $9 billion. But it was extremely fast-paced. It was extremely, get things done like today, and really had a lot of energy around it. And so I think that's the second thing that set me up. And I was successful in it because of my operating skills that I had learned from the previous one. And that one really honed me about the hard work and the scaling, and taught me a lot about how to scale companies and scale organizations.
That's great. So that takes us to scaling in startups. And I know scaling is one thing that you're big on, right? Because I see that firsthand, right? And you've helped scale several tech startups, right? Can you talk about the specific financial strategies that were most critical?
Yeah. I think, and it goes all the way back to PTC, and you were with me at Actifio, and we did some of the same stuff there. We weren't as successful as some of the other organizations that I was in, but still we fixed some things. One was PTC kept things simple and focused on getting things done, and so I've always done that. Keep things simple. And make sure you know the end game and focus on the end game and the most important things, right? Don't get lost in a lot of the unimportant things. And PTC was very, very good at that. The second thing was accountability, right? And so identify what your key performance criteria are and focus on managing them, getting them better, and developing them, right? And at PTC, it was productivity per sales rep. It was renewal rates for customers. In SaaS organizations, it's a little different. It's customer acquisition costs or LTV to CAC, long-term value versus CAC payback value. So regardless of the company you're in, whether it's a SaaS company, a software company, or a manufacturing company, I think identifying what those key attributes are and then measuring them. Companies scale successfully when they understand sort of, I call it when to step on the gas and when to take your foot off the gas. And if you get to a spot where you're not really measuring your stuff and you step on the gas really hard, you can run out of money, right? And you can run into trouble. The idea is, okay, I'm going to step on the gas for a little bit. I'm going to measure this thing. I'm going to see how fast we're going. And then I'm going to pause a bit. And then if it's still what I want, I'm going to step on the gas harder. If not, I'm going to pull my foot back and figure out what I should do next. So I think the ability to identify your key criteria, measure those key criteria, and figure out when to step on the gas and when to take your foot off the gas for those different things.
Yeah, if I seem to remember, you always said a company needs to be able to operate on its own.
Yeah, exactly. Yeah.
You said that. It's in my head all the time.
I think we had a sign in our area, right, Cuddy, it's a Warren Buffett saying too, a company isn't a company until it's making cash, right? So business isn't a business until it's producing cash, right? But that's right. Yeah. You got to, I used to tell people at Log Me In, which is another company that I was CFO of, all the time. I was like, they'd ask me all sorts of questions about why are we doing that? Why are we doing that? And the idea was we're a public company. We had to continue to increase our EPS and our operating margins. And, I said, guys, or guys and gals, the last time I walked in this morning, it didn't say, St. Mary's on the door. It said Log Me In, right? This is not a nonprofit. We are here to make money and we're going to make money, right? That's the objective of business, right?
Yeah, absolutely. What advice would you give to CFOs working in early stage companies that are aiming to scale? And what are the key financial metrics? I'm sure you've mentioned, I've heard you mention multiple, that they should be focusing on.
Yeah, let's start with the metrics first, and then we'll come back. The metrics are going to vary by industry. So it's going to depend on what industry you're in. And you have to identify what those key metrics are. Sometimes, like I said, it could be, CAC, customer acquisition costs, or the payback on customer acquisition costs. It could be in your manufacturing environment, it's how much does it cost me to make this thing, right? And how much am I selling in that, right? So it's going to depend. You as a CFO need to work with that management team and figure out what are those key criteria, right? And then you need to measure those. And the advice I would give CFOs is figure those out and like I said in the beginning, like be simple about it. There's no reason to overcomplicate the thing. You don't need 100 of these criteria, right? You probably need like 5 to 10 as a business that you're monitoring. And if you can monitor those 5 to 10 things, then you're probably going to be able to figure out how to scale a business. So I would keep it simple. I would identify what the key ones are, and then I would measure them. And I always tell, we did it at our organization too, but in my case, I ran what I call general administration departments a lot. So I had HR and I had IT and some other things in the organization, legal usually. Our objective as an organization is to help the company grow. And that is to help the company grow in revenue, grow in employees, grow in profitability, right? And so our objective is not to necessarily get in the way of those things. It's how do we help those things? Now, we do it with a set of rules and regulations, but we can never lose sight of the objective, right? We're not going to do things like fraudulently or things that, aren't right or things that are unethical, but we're going to do things that help the company grow as opposed to, I'd say, help the department grow or, manage cash in its minute, faction, right? The idea is how do we help this company grow by those different growth metrics, revenue, employees, profitability. And customers usually too. It would be the fourth that we'd put in there.
Okay. Now, obviously, it's 21st century. CFO, the role of CFO is evolving with time, right? It's not the same that it used to be 20 years ago or 10 years ago. I'm sure you know that. It's evolved significantly, so especially in tech startups. How do you see the role, the CFO role, changing in today's business environment?
They are definitely becoming more operating, and it's even happened within the last, 2-3 years. And I think it's going to happen even more in the next 2 to 3 years. And when they say operating, you look at, Tesla's a great company. You look at the Tesla CFO, and his major responsibility, I can't remember if it was a he or her. I think it was a he who did this. I believe it's a her now. But their major responsibility was like building the plants and making sure the plants were being built on time, right? That would not be a typical CFO, function. That would be someone in production or someone in manufacturing who would be doing that. But CFOs are becoming much more operating focused, and depending on their expertise, like in Tesla's case, I believe that gentleman came out of like Ford, so he understood the cost of a car and the cost of production. It was all about what is your area of focus. So CFOs are definitely becoming more operating. I think the reason I think it's going to change in the next 2 to 5 years, as much as it's changed probably in the last 10 years, is AI. There's no question that AI is going to have a huge component of CFO's jobs. And when I say that, I mean the ability to analyze results and analyze history and predict future and forecasts, I think are going to get more and more driven by a CFO's ability or its department's ability to be analytical with the data and to do that through AI functions as opposed to have a whole bunch of smart analysts, sitting around or running around. And so I think the use of AI is going to further move CFOs away from the old green eye shades, right, and accounting world and into the operating world. And I suspect a lot of them are going to be the people that initiate how do we get AI throughout the company? Where should we be using AI? Where should we be using it to either reduce costs or increase efficiency? So there's no question it's becoming a much more varied role. And not to babble on, Cody, because I can do that, but you look at then the backgrounds of people, right? I was a CPA, right? The typical path would be you're a CPA and you're a very good accountant and you become a controller and then you become a CFO. You see CFOs coming from all different backgrounds now, right? And they're coming from different spots because of the fact that that's a component of the job, but it's not necessarily that big a component of the job anymore. And it's more about how you're helping the businesses and how you're helping businesses grow.
I see. Wonderful. From a startup perspective, what are the non-traditional responsibilities of CFOs? You may have touched on that, but CFO instead of smaller startup, right?
Yeah, in the small startups, and you start with me at Actifio, right? CFOs tend to be like, I say I used to say they take on everything that nobody else wants to do, right? And so you would get, IT, and you would get HR, and you would get, in some case, manufacturing, in a lot of cases, legal, right? You get that whole general and administration stuff. And as companies grow, they can push that stuff off and move more stuff in as it gets bigger, right? I had it at LogMeIn too, the same level of responsibilities. But as we grew, HR moved outside of me and moved into the COO, right? And so as companies grow, same thing happened at Drift. It was the same woman who was great, the Chief People Officer, Dina Upton. But as it gets big enough, it's time for the CFO to sort of let it go and let it go into its right spot. So I always view myself as a little bit of a caretaker of things that people didn't necessarily want or weren't big enough to give to other people. And then over time, you hand it or you put it into the right spot. So as a result, you have to have kind of like no ego, right? Or you have to be humble enough to understand that that's your role, right? It's not about like how many people I have working for me, how many functions I have working for me. It's more about what's the best thing for the company and at what spot it makes sense to move that stuff away. But the reason I kept HR close to me in a lot of my places because it was extremely important to control hiring. And not control it from the sense of, interviewing everybody, but like how many heads you had, how many recs you had, how much you were paying per rec. Because in a software company, that's 80% of the cost, right? And so I wanted to make sure I, as CFO, had control over that until, in fact, I felt it was manageable enough, mature enough that we could kind of push it outside to the operating divisions, right? So I think you find that in CFO, in startups, right? They take on a lot of stuff. As it grows, you can move those things back to where they properly belong, I'd say.
Yeah, absolutely. Makes sense. Let's talk about angel investing. And I know you've been on the other side, and now you're on the other side. So I wonder how that feels. You've invested, obviously, as an angel investor, and you've advised over 7 startups. So how does your experience as a CFO influence your approach to angel investing?
Yeah, I may be a little different than the normal angel investor cut because I do it not to necessarily like make money. And I know people don't like to, and when you talk to other investors, they don't like to hear that. But what I do it for is my expertise is helping young companies and young entrepreneurs or young, startup professionals scale companies and grow. And I like seeing them be successful, right? And so what I have invested in are companies that I feel I can help, right? And that I can help in my area of expertise. So I don't angel invest for the sake of like making money. I angel invest for the sake of like, hey, I think I can help you. And I think I can help you scale. And, I'd like to get more involved in the company and help with that, right? That's the kind of things I've done. Now, my expertise comes in scaling companies. My expertise comes from a finance perspective, so I can help people build models. To be honest, my expertise comes from, I sit in Boston and I'm pretty well networked in Boston, so I can help people as they establish themselves in Boston. And I've done that with a couple of Irish startups that I've invested in, that as they've come into the United States, they've set up in Boston. And I've been able to sort of help them do that and help them sort of, manage the waves around both the Boston tech community and the entry into the U.S. market. So those are the kind of companies that I'm investing in and helping in. And I like to tell people, they say, what do you do now? I like to tell people I do a whole lot of nothing, to be honest, that I'm doing that a couple of days a week, and I'm doing it to stay active. I'm doing it to stay engaged. I do it because I have fun at it. I do it because I hope, these people appreciate, the impact I can have. They listen to my advice, and, it's fun for me to do. And hopefully, a number of these companies become successful. And I don't say that for my economic purposes, but I hope that I can look back and say, okay, yeah, we got, these kids to be able to build a company or sell a company and to make some money at it, right? That's my objective.
Wonderful. More long-term. So talking about financial metrics, there's always pitfalls, right? When a startup is ready to scale, right? So what are the common financial pitfalls you see startups make? And how do you guide them to avoid those mistakes?
They tend to go too fast, right? And so, and I say that a little bit cautiously, right? Because startups are meant to go fast, right? And they're meant to make quick decisions. But the mistakes The two sets of mistakes, as I think about the second ones. The first set of mistakes people make is they spend money before they have proven that they have the right product market fit, that they're spending the money in the right spot. And not just that they're spending a little, but they're spending a lot. And so they step on the gas and they go. You can get lucky, right? You can step on the gas and lo and behold, you think there's a mountain in front of you, and the next thing you know, it opens up and it's clear blue skies, right? It's possible. But usually you like, again, to measure and to step on the gas. So the pitfalls I've seen is they get all excited about some things that have worked and they go, let's run, right? And then they turn around and they look around and think, that didn't work too well. And, they're in trouble financially, right? They need to raise another round, or they spent more cash than they thought, or they're in a spot where you've sold the product in companies that it's not working and they got to put a lot of services around it. So I think that's the first mistake startups make. And then the second mistake that in hindsight, it's only in hindsight that I've kind of, I'd say I have identified these, and it's not necessarily in the startup environment, but all the companies I've been with that have been successful, Parametric Technology, LogMeIn, which went public, Drift, which sold at 17 times ARR to a private equity firm. We accomplished great things in those companies. But in hindsight, we could have been a lot more too, had we made certain decisions. And those decisions largely rested in investing in product. And so as a CFO, you tend to think, okay, let's not invest in more engineers. The issue isn't more engineers, but let's invest in product. And there are 3 or 4 decisions that LogMeIn is a great one, because we had a product, we're on Teams right here. We had a product that was Zoom-like before Zoom was even thought about, and it was really very, very good. But we did not believe in the market enough to double down on that. And we were cautious in spending on the product. Had we had done that, the trajectory of LogMeIn would have been completely different, but it would have meant a commitment to a Zoom-like product. Our product was called Join Me, but it was a collaboration tool. And it was all about, okay, we probably should have set up a development center in California for that. We probably should have not used the same, development managers that had developed the previous products. We probably should have went outside. We maybe should have done an acquisition in that space. But we had the infrastructure to do it. We had the thought that was going to be a big market. We just didn't invest enough in product. And I could do the same thing with Drift. I could do the same thing with Parametric Technology, now known as PTC software. So I'd say those are the 2 things. Be careful about like thinking you got something when really you don't, and you're stepping on the gas too much. And then 2, once you do establish some things, make sure you're investing enough in the product to understand at a certain point, products all reach a maturity and you need something else behind it.
I see. That's good insight. That essentially brings us to the end of the discussions with Jim Kelleher. Jim, is there anything you want to add?
Cool. No, the only other thing I'd add is I know you did it on the intro where you said you guys are an outsourced CFO function. I'm an angel investor in 7 companies now, right? I really see the benefit of doing that at a young age of these companies. They can't afford CFOs, they can't afford controllers. I'm doing it a little bit as an angel investor and helping, right? But I think at a certain point that there's a huge need for a service like what you guys are performing from an outsourced accounting and outsourced CFO perspective. So I know you've been very successful personally there. I know the company's successful, but I can really appreciate the market now that I'm a little bit looking at it from the outside as an angel investor.
Kind of why we have you on this call. Thank you so much, Jim.
My pleasure.
It's been a pleasure. Yeah.
Yeah, the pleasure's been mine. Thanks.
Bye.
Thanks for joining us. Be sure to subscribe to our podcast so you'll be first in line to hear what's coming next. Don't want to wait for our next episode? Check us out at withum.com. That's WITHUM.com.